Will interest rates rise? Yeah, they probably will. Cheers. Got on a new video now. See ya. Oh, okay, so you're still here. Good. Let's jump into, will they rise? When will they rise? Why do they rise in the first place? And how can you mitigate against them? So let's start with why. Why do interest rates fluctuate over time anyway? Well, first of all, let's just get a very basic understanding of interest. What is interest? Let's keep it really simple. Interest is a cost of borrowing, and it costs one party and is an investment return for somebody else. I.e., when you borrow the money, you pay on it. When somebody lends out the money, they collect the income, right? So why does it fluctuate over time? Well, a really big one is actually demand. So when demand increases for a money flow or any situation, if you follow the basic economic principle of supply versus demand, prices increase. You know, if I've got $1 billion to lend out, which I don't, but if I had $1 billion to lend out and there's 1.5 billions worth of applications that came in, I can't lend it all out right now, okay? So what ends up happening is, I tell you what, I've only got $1 billion, I'm gonna increase it by 1%. Who still wants it? Oh, 1.25 billion. I'm going to increase it again by another 1%. Who wants it? 1.05 billion. Perfect. That's what we're going to be charging. So as demand goes up for anything, prices typically will follow, or cost implications on this in interest follows. The next is risk. When risk increases, interest rates will also increase. Okay, so this is pretty obvious. If I lend out $1 billion, but I know 5%, i.e. 50 million, will default, not pay back, and that's how much I'm going to lose, then I need to factor that into my interest rates, right? Whereas if I know 10% or 100 million isn't going to pay back, then I'm obviously going to charge higher interest rates. So remember, risk equals reward. So a lot of people look at yield on property and they've got a really high yield. Well, often that either represents you've got it at a really good purchase price, or your tenant type is typically higher risk based on other areas of the country. So London will have a very low yield, sometimes 2-3%, but the values of property will just continue rising because it's a very safe environment. Risk equals reward. When the lender's risk goes up, you start paying more. Number 3, the silent killer, inflation. Again, inflation is the stepmom that nobody wants in their life, but let's face it, you have to put up with her. So inflation comes into your life in many ways, and mostly it comes through price increases, okay? So the value of a pound today is worth more than a pound tomorrow, okay? And as inflation increases, that means costs increase, which means the banks or the lenders want to make sure they're still getting their margin, so interest rates will increase alongside that. So this links in with the next one, which is LIBOR. Some of you may not know about this. LIBOR is the London Interbank Offer Rate, and it's the way that the central banks are lending out. In America, I think you have the Federal Reserve doing this, and essentially it's called the base rate. So if you ever read some of your contracts, it will say base rate plus 2% or LIBOR rate plus 2%. This is what all of the banks are lending to each other in. And if you look at fractional reserve banking, I love geeking out on that sort of thing, but not the video for it, so I'll try to stay focused. Essentially what it means is if I lend you £1, you can lend somebody 10. Or if I lend you 10, you can lend somebody 100 because of the way it works in banking. Or in the last recession, they were 75 times it. So if I gave you $1 million, you could lend out 75 million. Who knew that level of leverage would hurt somebody in the future, obviously. So as the LIBOR rate goes up, which is impacted by all of these things, then that is going to increase the cost to the lender, which of course they don't suffer, they pass it on to you. Okay, so even in fixed term contracts, sometimes they'll have ways to break it. Very, 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 very rare, but they want to mitigate their risk by passing that cost on to you. The final thing that impacts this is individual risk. Okay, so it comes down to you, and obviously if you're more risk, you will be charged more. So let me give you an example. If somebody's going to lend you money and you've never defaulted, you've shown that you've lent money before and always paid it back, you've maybe got a property portfolio, I'm going to lend you, I don't know, 50% loan to value, and I'm going to have a first charge over the asset, I'm feeling pretty secure. I don't really need to factor in that much risk into what I'm going to charge you, okay? Now, risk is measured by variance or variance squared. It's a bit geeky and not really how we're going to go through on this. But if I lend to you and you have done a few properties, but actually you defaulted on one, you might have paid people back eventually or you might have settled, but you know, you're screwed financially, you're blacklisted, as they say, which doesn't exist, by the way, but you've got a poor credit rating, and you're not going to be able to give me any security. You can tell then that I'm going to be charging much higher interest rates to factor in the individual risk of you as an individual. So overall, I think I've covered everything there. That is why interest rates will fluctuate over time. So the question is, when's it going to happen? So another thing that they're going to take account of is the economy in general. So they're all of the analytics, but also having a holistic picture of what the world is going through. So for example, right now, actually things are going really well in the economy, believe it or not. And there's some areas that are crippled. I get that, like it's not for everyone. But does that mean that you should be charging more considering how many people buy them? Well, no, because if you suddenly increased interest rates now, I think you'd find a lot of people going out of business. And it's just being aware. It's like when people talk about EPCs going to D on there and really worried about it. It's like the government is clueless on that, because I don't think they realise how much of the property market would just be slammed down because a majority do not reach that criteria, okay? So thinking about that. But it is being smart. If you think one of the highest rates, base rates, this is LIBOR, so banks will be putting on top of this, historically has been 15% interest. Imagine, let's say they put in 3% on top, which isn't crazy, getting charged 18% interest for the debt portion of your lending. Like, absolutely phenomenal, right? But then again, in 2020 and 21, it went down to 0.1%. Okay, lovely jubbly. We love you banks, we hate you banks, and actually we just tend to hate banks all round, right? So the thing is, if we know it can fluctuate between them, should we be nervous? Yes and no. Typically you want a long-term mean or median of this, which will typically come in around there. Often quoted between 5 and 6%. If you check out your own resources, you'll see that it fluctuates between that. So if I know that's a long-term average, which will start coming down, by the way, that's what you should factor things into. Now, it's hard to see a world where we're suddenly at 15%. Those were some quite extreme times and the market was just going like that. So you could actually warrant it, because as long as your income was at least covering your ass on the interest payments, your value and net worth was going up significantly at the time by owning property because of the value fluctuations and expansion, an increase within that. Likewise, can I see a world where we are continuously at 0.1, 0.5, 0.75, I think it is now, percent? No. Something you really need to understand and not get comfortable with is this. We are at historic lows, okay? And what I mean by that is it kind of can't go much lower. I mean, technically it can. There's some negative interest rates in some countries right now, which is where you are getting paid to take money and build a portfolio. That's pretty cool. But you need to factor in this, that actually this is not a likely long-term situation. So you need to protect against this. Do I think it's going to happen anytime soon? No, because I think honestly any significant movement just starts scaring people. But I definitely think if we think about what I just went through, increased risk, inflation, all of those things kicking in, with everything that's happening in the UK right now, furlough coming to an end, stamp duty coming to an end, all of that, it's easy to see a lot of unemployment coming up in the next couple of years unless there's more government stimulus. That means defaults on loans, that means selling off cheap, that means people getting in a bit of a pickle, which means if somebody else doesn't pay, you can guarantee you are going to. So personally, what I see is I think it's going to be relatively stagnant over the next few years. And then I think we're going to start seeing a steady increase in interest rates. And then when we're in a very solid growth stage of the economy, bearing in mind the cyclical nature of the economy, I think that's when we're going to see some real pushes on the increase on interest rates. So I think it will be something like this. So we're at 0.75-ish now. I can see sort of a 3, 7 and 10 year time frame where I think it will be something like this for the first 3 years, maybe reaching a 1.25 in 3 years time. I think it'll be a bit more over the next 7 years, maybe creeping up to that sort of 4%. And then I do think here's where it's sort of the unknown quantity, if you like, where I think it could go like this, it could go like that, it could go like this. It really does depend. And so many people try to predict 20, 30 years from now, and I just think it's bullshit. And second of all, I don't really care. In general, property will go that way. Yeah, pretty obvious. In general, rents will go that way. So I'm not trying to perfect the market. But the real question is, how do you protect against this in your own portfolio? So here's my current strategy with what I'm doing with my portfolio purchases. Number one, I am purchasing on an interest only, typically a 25 to 30 year term on a buy-to-let mortgage. I'm making sure I've got 150% coverage. What that means is if I'm earning 1,000, or say the mortgage is £1,000 to make the numbers easy, I will need my rent to be 1,500 to make sure I feel comfortable, and I will work that out at 5% current interest rate. Sometimes I'll do 6% if I'm a little bit nervous, but making sure I've got that coverage in there, and I will do a 2-year fixed. Okay, they're pretty typical. They often get some of the best rates. I also might want to refinance in that period. So I don't like fixing myself in too much. And the reason for this is because I typically get below market value property and I want to release some of that equity and get my money working harder for me elsewhere. That's what I would do as stage one. Stage two of this, as it gets to the end of that term, we obviously analyze the current market, but typically I will go for a minimum of a 5-year fixed and negotiate the best deal that I can out of that, or I will push for much more. So if I think the economy is really starting to make a move and I can see something a bit stronger, I will negotiate for as long as possible within reason, probably up to a 10-year fix. The reason for this is once you start building a portfolio, I know this sounds really lazy, but I just can't be bothered refinancing every 2 years to release equity. It's like for an extra 10 grand, it's not really worth it for me at my level. Also, I just couldn't, like, it feels like all the time, I'm always bloody signing new contracts all the time. I don't want to do it every bloody week that I'm coming in. Oh yeah, you're refinancing this, you're refinancing that. Kind of feels like that already. So I'd rather delay it. I also like the idea of letting the capital growth compound in itself and build itself up. Also remembering every time you refinance, there's a new set of fees and risk associated. So get your 2-year fix. This is what I personally do. It's not advice or financial advice of any kind. I'll usually get my 2-year fixed. And then once that's coming up, I'll look at the values and do a 5 to 10 year. The only time that I wouldn't do that, and I might actually just let it go on to the variable rate, is if LIBOR has dropped significantly and therefore the rates have dropped. In terms of current situation in the economy, I can't guarantee it, but I near guarantee it's not going to drop much further than it already has. So another big reason is I really like focusing on growth, and I believe in order to build the biggest building or jump as high as possible, you need the most solid foundations in order to build upon. Now for me, I don't like needing to look behind me every 5 minutes, because if I'm constantly looking behind me at people, rates, risks, all of that, then I'm not focused on what's in front of me right now. And for me, I like to double down on this growth. But for me, that's just my strategy. What is it that you do? If you do something different, if you think you're going to do the same, let me know in the comments. And more importantly, why are you doing it? And hey, if you got value from this video, make sure to smash the like button and lightly tap the subscribe button if you want to find out more about property investment, growth and scaling. And by the way, before you go off, make sure to check out this video right now, which is the interest versus capital repayment video that I did around a month ago, showing you the benefits, the pros and cons of each. Head over now and I'll see you in the next video.